Hey guys, I have a bit of a more interesting video for you today because it feels like our stock portfolio keeps hitting new all-time highs after new all-time highs. Here's our year-to-date performance. I made this portfolio, this Robinhood account specifically to, try to outperform the market, which is the S&P 500, the top American companies, the top 500 companies in the United States. They're actually up 20% year-to-date, so we're doing almost double the S&P 500 year-to-date performance, which is pretty cool. And that's because I feel like I have selected very high quality dividend paying stocks. So check this out. Every stock that you've seen here does pay a dividend. Most of the dividend yields are under 1%, but that's okay because they will grow over time so much. All these stocks have so much room to raise their dividend. And I want to go over a few stocks in particular that just keep performing really good. So here's our total percent change on all of our stocks right now. And I want to talk about Salesforce really quick. It's the first stock because this one, it's the highest up we've ever been at since we owned it. So we bought most of our shares down here on this dip, and our average cost is $244. So we bought some, back here. Then it fell. We lowered our cost basis, and here it is today, back at $280. And congrats to Salesforce, man. We also have a dividend coming in from Salesforce of $3.20. And if we quickly go ahead and just look at Salesforce's financials, because this is why I own this company. This is why this is a very high quality dividend stock. I also own 2 shares of this in my Webull account, but look at their net income growth. This is a software company with really high margins. So they're finally starting to crank out net income. Look at that, making well over $1 billion every single quarter. They're growing their top line revenue as well, still 8% growth year over year. But more importantly, I like to look at, here's the EPS, which is their net income per share. I like looking at the free cash flow per share. And this is off the charts. I mean, they're making more free cash flow in terms of numbers. They're making more free cash flow than Coca-Cola. So this is their free cash flow down here. They make most of their free cash flow in that one quarter, Q1. They made $6 billion, which is up 40% year over year, which is absolutely crazy. And they have a phenomenal balance sheet. So here's what I really like about Salesforce. They have a lot more cash than debt. So they have $5 billion in short-term investments. And remember how they were making, $6 billion of free cash flow in that one quarter? Well, their dividend only cost $384 million. So their dividend is literally dirt cheap. They can easily afford that from a net income and free cash flow point of view. But look at their total debt. It actually just went down by a good chunk, exactly $1 billion. Look at that. In the most recent quarter, they paid off $1 billion worth of debt. So they only have $8.43 billion worth of debt. And just in cash and equivalents, they have $7.68 billion. So that's really crazy. They're also making interest from that cash in the 3 most recent quarters. Look at that. They're actually making interest instead of paying interest payments on their debt, which is a great sign. And finally, another great sign about Salesforce, they bought back $4 billion worth of their own stock in the most recent quarter. Salesforce is a stock buyback machine, and they used to not be, look at this, they used to dilute you as a shareholder, issue hundreds of millions of dollars of shares every single quarter to pay employees. Now Salesforce is finally, focusing on shareholder returns. They're doing dividends and share buybacks. So that's what I love about Salesforce. That's why it's it's my second largest holding actually. Well, it actually might be my third largest holding. I say that because if we head over to our Moomoo account over here, look at Powell Industries. This stock also, I think, it's at a new all-time high today as well. I mean, so many of our dividend stocks are doing great. But this is Powell Industries. It's worth $2,786 now because we're up almost triple on that stock. And Salesforce, we have 2,200. So yeah, Salesforce is our third largest holding. And let's go to our fourth largest holding, which is Google. We now own 12 shares of Google. And check this out. If we actually scroll down really far down here, we bought 1 share of Google today. Today's October 3rd. We bought 1 share of Google today. Not that big of a deal, but we now own 12 shares of this stock. We're actually barely up on this stock right here. If we go to our total percentage change, this is the stock we're up the least on. We're only up 2% on our shares. All other stocks, we're up over double digits on every other stock in there. But let me tell you why I really love Google stock. I'm sure it can speak for itself, but let me go ahead and show you. Actually, I'm sure this will impress you. Their numbers will impress you because they blew me away. So check this out. Google is still growing their net income in today's environment. So look at this. They're up 18% year over year to $24 billion just in one quarter. So remember, if you annualize that, that's $100 billion a year of net income. But remember that number. They made $24 billion just in one quarter. And I'm not sure why this isn't loading, but remember that number, $24 billion in the most recent quarter. And look at this, their dividend only cost $2.4 billion. So that's a 10% payout ratio just for the quarter. So that's really impressive. So their dividend only cost $2.47 billion. And on top of that, they have $14 billion of debt. So $14 billion of debt, and they got $27 billion of cash on hand. Now, this is their cash. Now, let's look at their short-term investments. They also have $73 billion in short-term investments, which is like the 1 to 3 week treasury bonds. And so they basically have $100 billion of cash, $15 billion of debt, so much room to raise their dividend. And what are they doing with the $24 billion of net income a quarter? They spend $15 billion of that on share buybacks. So they're spending so much money buying back their own stock, which is a really great sign if, as a shareholder, that will keep buying back their stock as it goes lower. And I'm sure they did a lot of buybacks down here or something, but I should have bought the dip more on Google. But this is a no-brainer long-term hold. I'm never going to sell my Google shares. Why would I? They're a great, fantastic dividend-paying stock now. Honestly, I don't know if I would have owned them if they didn't pay a dividend. It's so cool that they're paying a dividend now. They're now going to be more financially disciplined with what they do with their money. They're a more stable investment. And let's go to the next stock right here. So this is Realty Income. This is a company that's in the S&P 500, and they also pay you monthly dividends. So if you buy 30 shares, so I own 30 shares. So I own 30 shares. That actually pays me $7.91 every single month. So if you buy Realty Income 30 shares, you'll get $7.91 for the rest of your life, assuming they don't grow it. And on top of that, here's what's crazy. We're up 20% on a stock that you should get most of your returns through in the form of dividends. But why is the stock going up so much, 20%? Well, most of that's in the past 3 months because of Jerome Powell cutting interest rates. So since this is a real estate stock, they benefit heavily from lower rates because they get most of their money from lending and they borrow the money. So if they can get a lower rate borrowing, then they can get a higher return on investment through whatever they invest in, through their triple net leases. Realty Income does triple net leases. They have about a 75% payout ratio, which is completely normal for a REIT. So that's why I really like them. I won't spend too much time on them, but I also, now we'll go over to Meta Platforms. So this stock right here also hit an all-time high today. So that's what's crazy. They're up 91% in the past year. And we didn't even time the bottom on this one. See, they're up 65% year to date. We're up 31%. So if you ever bought Meta before, you're definitely up on your shares. So that's what's crazy. We're up over $400 on Meta. And here's why I think Meta will just keep going higher. Here's why Meta deserves to be at all-time highs, and that's because of their financial condition. So look at their EPS, first of all, the earnings per share, the net income per share. It's up 73% year over year. Here's their net income right here. It's up 82% year over year to $14 billion just in one quarter. And if we, so that was their EPS. Now let's look at the free cash flow per share. So Meta's doing even better if we look at their free cash flow. They're nearly making $8 every single quarter in free cash flow per share. And their dividend only cost 50 cents a quarter. So imagine they could afford to easily pay $1 to $2 in dividends every single quarter. So they could 4x their dividend right now if they wanted to. They just choose not to. So since Meta isn't raising their dividends so much, as you can probably guess, they're doing some insane stock buybacks. So check this out. They bought back $6 billion in the most recent quarter. The quarter before that, $15 billion. So Meta's buying back their own stock like crazy. And they do that every single year. Look at that. Look at this year in 2022, they were buying back so much of their stock. Wow. So it's still good to see that they're still doing stock buybacks. That's a great sign from Meta. On top of that, if we look at their cash and equivalents, they have $25 billion of cash. Remember, you also have to remember they have short-term investments. So they have $25 billion in cash, 26 in short-term investments. So that's over $50 billion in cash. The only difference between the two is short-term investments is the money actually invested in the short-term things like the 1 to 3 week treasury bonds, the money market funds, things like that. Here's their diluted normalized EPS, $5.45 the most recent quarter. Amazing numbers. And total debt of only $18 billion. So they could pay off all their debt right now if they wanted to. That's why I love Meta. And on top of that, look at their interest on their cash that they're making. So since they have $25 billion in, money market funds and the interest rates, they're making $244 million a quarter off that. So yeah, that's why I love these. This is why all these stocks are at all-time highs. I just absolutely love them. And now I want to talk to you guys about Constellation Energy. They just had a partnership deal with Microsoft. So they went into a deal with Microsoft to repower a nuclear facility in 3 Mile Island. But on top of that, this company right now just has amazing financials. Oh yeah, they were up like crazy today. They were up 4.52%. Yeah, all-time high on Constellation Energy. So here's why I love this one as a dividend stock. So they just revised their guidance. So since they just went into a partnership with Microsoft, they expect now their growth rate to go from 10% to 13% plus, which adds up a lot. But remember, look at this. They made $810 million in the most recent quarter. In just one quarter, they made $810 million. And here's their dividend. Their dividend only cost $110 million. So obviously this company has a ton of room to raise their dividend if they wanted to. And this is a utility stock. So it's actually normal for them to have high dividend yields. And this company right now, they're also doing, since they're making so much money and have such a low payout ratio, look at the amount of stock buybacks that they were doing. I mean, they were doing some insane stock buybacks, $1 billion worth in just the 2 most recent quarters, $1.5 billion. And those stock buybacks were really effective. You know, it was way before this huge run up right here. So that was like, well, they're getting a good return on their money when they bought back their shares. And look at the market cap. It's $86 billion. So if they buy back $1 billion of the stock, that's well over 1% of the entire company. So that's what I love about Constellation Energy. You know, they're a pure play on the energy sector. In the carbon-free energy, they're 100% carbon-free. They don't release any emissions or anything like that. So that's what I love about Constellation Energy. That's why we're up. Yeah, I didn't even show you this. We're up 64% on our shares. So we got a really good cost basis on them at $168. And I remember when I bought this stock at $168, I wasn't too confident. I was like, I'm paying a fair price on this. I'm if not slightly overpaying. I didn't think I was getting a good deal on this stock, but it ended up being a great investment that I'm not going to sell either. So I now want to talk about McDonald's. So this stock right here, we're up 23% on our McDonald's shares, which is crazy because they're also a miniature REIT, a miniature real estate investment trust, because a ton of their market cap is the real estate that they own. So I see that they actually move whenever the REITs move is what I've noticed, which is pretty cool. But anyway, this stock is basically at an all-time high today. It's a couple bucks off all-time highs. And here's why. So let me show you. First off, they have a dividend yield of 2.33%. But let me show you their amazing financial conditions. So it's true that in the most recent quarter, they are down 12% on their net income, but also look at the year before. This is such a hard comparison. They were up 94% on their net income the year before. So we have some tough comparisons. But either way, I still really like McDonald's. And if we head over here, oh yeah, so since this is a restaurant stock, you don't look at their assets to liabilities ratio. Their liabilities look way high. It doesn't count assets that are like the franchise. It doesn't make sense. Either way, what I'm trying to say is the stock wouldn't be at all-time high if the balance sheet was really this terrible. And here's their free cash flow down here, $1.69 billion in the most recent quarter. But anyway, let's look at net income for this stock. So they made $2 billion of net income in the most recent quarter. So $2 billion of net income, and their dividend cost $1.2 billion. Now, that is a dividend payout ratio of over 50%, but since they are kind of like a REIT, this dividend payout ratio is normal. Like Starbucks has the same payout ratio, if not a little bit higher. Oh yeah, here's their diluted normalized EPS. So yeah, it is down 5.58% year over year, but McDonald's is a consistent grower, and I like looking at the diluted normalized EPS because it includes stock-based comp, exercise options that the normal EPS doesn't, which is pretty cool. But anyway, total debt of $38 billion, and look at the amount of stock buybacks that they're doing. So McDonald's spends roughly $1 billion every single quarter on stock buybacks. So whenever I see a company having so much extra money to do stock buybacks, I know that they could use that money to pay off debt instead. But they just don't need to right now. So McDonald's, could easily pay off $4 billion of debt every single year. So the debt McDonald's is in is not a problem. I also just seen this crazy news about Elon Musk and McDonald's. So they both have this event for labeled 1010, and Elon Musk actually followed the head of marketing at McDonald's. And this is actually Kai Cenat's like setup, if you know who that is. It's a popular Twitch streamer. But anyway, I wonder if they're going to announce something on the same day, maybe like an exclusive Tesla McDonald's delivery kind of service. I don't know, but either way, this could be really cool. And it's kind of a cool sign to see Elon Musk reply to this tweet and follow the McDonald's head of marketing guy. So who knows what they got in stock for us. But let's go ahead and get back to our portfolio. So that was some interesting news I wanted to share with you. So now let's actually go over, because we looked at all of our stocks in our Robinhood portfolio. Actually, we looked at all of our stocks in our Robinhood portfolio, except for our largest holding, which is also at an all-time high today, or just a couple bucks off all-time highs. And let me actually, since we're doing this, show you why it's my largest holding right here. So it's my largest holding by far for many, many reasons. So first off, this company is trading at a very fair valuation. Look at the forward PE ratio. It's a 21. They have a really low dividend yield, like I said, 0.89%, but they're also almost the dividend king. They're at 48 years of dividend growth. So their dividend every single quarter cost $1. So this will be easy math. Their dividend only cost $1 a quarter. And just look at their free cash flow per share. You know, they could pay for the entire year's of dividend just basically in the most recent quarter. On top of that, look at their EPS. So they sold off one segment of their business and got a lot of net income for that. So it says they made $14 in EPS. Let's actually go ahead and look at their diluted normalized EPS, which doesn't include that because that kind of skews the numbers, makes it look like they're doing better than they actually are. So here we go. Here's their diluted normalized EPS. They made $5.96, which was up 34% in the most recent quarter or year over year. So that's a really great sign from our largest holding. But let's see how much their dividend cost them. So their dividend only cost $40 million a quarter. So remember that it only cost $40 million. And look how much this company is spending on stock buybacks. They spent $531 million just in the most recent quarter buying back their own stock. So now if we go to the total common shares outstanding, you now own 7.2% more of the company than you did 1 year ago. So that's kind of like a 7.2 non-cash dividend yield. It's like a return of ownership to you on top of the 0.89% dividend yield. So you get dividends and stock buybacks with this company. They have a lot more cash than debt. Oh yeah, remember how I said their dividend cost $40 million a quarter? Well, they made $285 million of net income in the most recent quarter. And look, we can see their operating income. So this net income does not include that huge gain of the sale, which is good, but $285 million, they can easily afford the dividend and afford to raise the dividend if they wanted to as well. So that's why this company is my largest holding by far, and this company themselves gave out a projection that they're going to make, they vision to, in 2030, so this is a long time away, over 5 years away, but in the year 2030, make over $40 plus of adjusted EPS. And if you do just a 20 times multiple on that, that's a $800 stock price, and today it's $447. So the stock could potentially basically double by the year 2030. So that's why it's my largest holding by far. I absolutely love Carlisle and their whole company. We're up 38% on our shares as well. So a very impressive gain on their behalf. And we bought that stock at all-time highs, and it just keeps hitting new all-time highs. So a few other companies that just keep doing amazing. So we already looked at Powell Industries. They're also at an all-time high today. But let me show you Cubesmart. So this is my second largest holding in my Moomoo account. So this is Cubesmart, the real estate investment trust. So kind of like Realty Income, this one also has to pay out most of their income in the form of dividends by law. So they have a huge 3.92% dividend yield, my second largest dividend payer. And they're basically, well, actually not at all-time highs. They're very close to all-time highs. You know, they hit an all-time high just a week or two ago, but I really like this company. They pay a lot of dividend income to me. On top of that, this is the number they pay out the dividend from right here. I'll be quick with this. Look, so they made $170 million in the most recent quarter. And keep in mind, they have to pay out most of that number. Their dividend only cost $115 million. So that is a very fair, healthy payout ratio in my opinion. That's why I really like this company. They're also in the self-storage sector, which is a sector that I really like. It's month-to-month lease. They can easily capture inflation, low maintenance, high margins, all that kind of stuff. These self-storage properties are profitable with a 20% occupancy rate. So that's what's crazy. And most of their properties have 90% plus occupancy rates, which is kind of crazy. So great sign for Cubesmart, in my opinion. Remember, nothing in this video is financial advice. This is all just my opinion. I'm just some 20-year-old giving just showing you what my portfolio is. And we also have Nike. You can see exactly where I buy all my shares in here. And they just reported earnings, and I'll be honest, the earnings were not good, but they also were expected to not be great. But look at this. We can look at their net income was down 27% year over year. So that's actually not great. And their top line revenue was down 10% year over year. But it's not all bad for Nike, because look what they're actually keeping up. Their gross margins are at an all-time high, up 3% year over year. Their operating margins at an all-time high. Their EBITDA margin, their net margin, they kept their net margin. So they're keeping their margins up, although the company is losing, sales, losing traffic. So that is a bit of a concern for Nike, but I really like them. Another stock I've been buying here is Disney. I plan to buy some more shares of this one. You can see I've basically bought all my shares over the past, month or so. And I plan to keep buying more Disney, especially if they keep coming down in price. If I go negative on my shares, I might even buy another like 4 or 5 shares of them. So I'm really liking Disney right now. We of course have some losers in here like Perion Network. This company is completely debt free. They have zero debt. They have more cash on hand than their entire market cap. But I do beware. They are kind of losing money right now because they lost a contract with Microsoft. So that's a terrible sign. Look, I was buying this company when this was their free cash flow numbers, and now in the most recent quarter, they lost $21 million of free cash flow. No investors were expecting that. That's why the stock keeps falling. But remember, this company has zero debt, more cash than their entire market cap, and a very low valuation. But again, they can trade at a low valuation because there's no growth. Where's the growth story behind that company? There really isn't one right now, which is kind of unfortunate. Also, I want to show you Docusign. So this company does not pay a dividend, but there's a lot of unusual options activity, which leads me to think, just my prediction, could be false. I don't know. I think this company is going to get bought out in the next, couple weeks to a month or so. Docusign is going to get bought out potentially around $70 to $75 a share. Just my prediction right now. Who knows? I really like that company. Docusign also is debt free. Oh yeah, I made a watch list right here. Thanks for kind of watching till the end of the video. If you made it this far in, don't forget to drop a like on the video. Seriously, I really appreciate you. But here's a watch list I have of companies with zero debt. So every stock you see in here has zero debt. And also Hims and Hers stock just fell a bunch. 10% today basically. So I'm thinking about buying some shares of Hims and Hers stock. I don't know. But yeah, that was pretty much the entire video. If you got any stocks you want me to look at, let me know in the comments. We also have, EOG Resources, the oil play. They're so close to all-time highs, a couple bucks off. This is the oil play, and we're up 9.86% on them. They also pay special dividends. They're in the natural gas, crude oil industry, of course, but they pay a lot of special dividends if you go to their history. But yeah, they have a 2.65% dividend yield, 25% payout ratio. Anyway, thank you guys so much for watching. See you guys in the next one.